Welcome to the program. Today we'll talk about the Switzer Investor Strategy Day and some of the key themes that are coming out of the roadshow, and we'll also look at investing offshore. I'm Marty Switzer.
I'm Paul Rickard.
And we're mad about money. Paul, we're in the middle of our Switzer Investor Strategy Day, our second one we've done since the inaugural one being last year. The topic has been investing for income and growth in the world of Trumpflation. What are some of the key themes that our investors, our experts, I should say, have been talking about over the last few days?
Well, look, I think a couple of things, Marty. First of all, I think they still see very much Australia as an income-focused market, and if you're looking for growth, you've really got to go offshore. I think that's probably whether they've got an income product here in Australia or they're talking about more macro view. That's really coming across as a very clear message. I think that's number one. I think number two is they still see some value offshore. It may be more on a sort of a high conviction basis in terms of stocks and sectors with particular tailwinds, not necessarily the whole market going up. I think everyone's just a little wary as given the run in offshore markets, but they still see value, and I think that's also come across pretty
One of the
strong.
questions we got from an investor that I was talking to this week was about, I guess, asset allocation. And a lot of self-managed fund trustees actually don't have a financial advisor, but they've still got to have an asset allocation, understand the principles of how it works. If someone was a balanced investor, what sort of exposure should they have towards global equities? And then on top of that, how many managers or products would you sort of allocate your global component to?
Yeah, they're two really good questions. And I think, unlike many investors, all the data says that we really, most SMSFs are underweight offshore compared to how institutional funds or institutional super funds approach it, or potentially some of the more traditional asset allocation weighting. So typically, balanced fund, you might have sort of 60% in growth assets, 40% in income assets like cash and fixed income. Of that 60% in growth assets, maybe 35% in Australian equities, 20 to 25% in international equities, and maybe a little bit in property.
That's a growth investor talking about.
No, for a balanced investor,
okay.
yeah, with the 60% in growth assets, yeah. I mean, you still might have 20 to 25% in international equities, and I think the data...
You do get variances, though, in this whole balance thing, because sometimes they say it's 50-50, sometimes they say it's 60-40. Is that...
I think I'm probably more in the
60-40.
The 60-40 category, but You're right. I mean, it is. There is no hard and fast rule, but look at most of the sort of default super funds, and which are a good guide.
60-40 growth.
At 60-40 growth, and they'll have sort of typically 20 to 25% international equity. So I think that's an important start. The question is how you then do it. Now, obviously, you can buy individual shares. That's hard, but it's becoming increasingly easier with people like NabTrade and others. But it's really hard to actually build up a portfolio that may actually just have the exposure to the different markets and the different types of themes you're chasing.
So would you adopt a core satellite approach where you might go, largely sort of index for part of it and then have some managers around that, or would you just allocate to four managers?
I think it does make sense to have a little bit index. Sometimes that's just easy to get country exposure.
IOZ or something like that.
Yeah, IBV or something, and you can look at things like that. But I think also that a lot of the managers where they've shown they're really good, what I describe as conviction style managers, who are good at identifying, portfolios of 20 to 40 style stocks, and you back those, and you probably back two or three to give yourself some manager diversification.
And what percentage of the overall allocation would you give to those sorts of managers?
I think if you're sort of looking at sort of 20 to 25% national equities, you might have a core of maybe 10 to 15, and the other 10% you could shift out amongst three managers.
Yep.
I mean, look, I'd love to say that it's easy to find the great stock, and I think that you can do a bit. It's nice to say you can pick the stocks, but the truth, most people will probably move away from that and probably use a manager who can then also manage the currency risk. I think that's the other thing managers can do.
So you're sort of saying half sort of core, half
I think
active
that's one way to approach it as a probably easy
passive
way to get started.
Active,
I think the most important thing is to get started. And I think that's probably the lesson for Mad About Money today.
And Paul, you've just written an article on investing offshore, which covers some of the issues we've spoken about today and more. Talk us through it.
Yeah, a little bit more, but the where, the how, and the why, and really does focus how you go about doing it. And I think that's a question I get a lot of times from a lot of people, because they do know they're underweight and they need to think about how they're going to do it.
For more information, go to switzersuperreport.com.au. I'm Marty Switzer.
I'm Paul Rickard.
And we're mad about money.